Fear is what drives precious metals. And again, in my experience, a silver bull market needs to be led by a gold bull market. The gold buyer tends to be a fear buyer, and the fear buyer acts first. Silver moves then further and faster.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Rick Rule joins us today. Rick is a highly experienced investor and speculator, and he has structured, led, and participated in hundreds of privately placed debt and equity issuances for resource companies operating internationally and domiciled in Australia, Canada, Chile, Great Britain, New Zealand, to name a few, and the US. Rick is a sought-after investment conference speaker as well, having presented at hundreds of resource and investment conferences over the last 30 years. And today, Rick heads up Rule Investment Media. And we're delighted to have Rick Rule join us once again today. It's time to saddle up and silver up for Rick Rule. Rick, welcome back to SBTV. How are you doing?
I'm fine, Patrick. Always a pleasure to be on with you. Thanks for the opportunity.
Glad to have you back. Appreciate it. Rick, I really want to start off with your upcoming Rule Symposium, Natural Resource Investing. I looked at some of the names there, and heavy hitters: Danielle DiMartino Booth, David Stockman, Andy Schefman, Nomi Prince, to name just a few. And again, this is one of the best lineups of heavy hitters that I've seen in a while, an A-list. So I just want to start off by asking you about the Rule Symposium coming up.
Well, thanks for the opportunity. Of course, that's one of my favorite topics. I think it's important to note, first of all, that this symposium has been going on for more than 20 years, which is to say it's stood the test of time. One of the ways that we have stood the test of time is that we choose every year's speakers based on the preferences of our audience. I don't choose the speakers. The audience chooses the speakers. The audience for years has appreciated the fact that we have brought, as you would say, heavy hitters, people that are able to explain a paradigm that's different from the paradigm that you might see on the BBC or CNBC, but an important paradigm nonetheless, a contrarian paradigm, a value investing paradigm, a natural resources paradigm, and a precious metals paradigm. If you agree with that worldview, we also bring in analysts and portfolio managers who have 30 and 40-year track records in natural resource and precious metals investing. We are not inclined to bring in some young hotshot who 5 years ago couldn't spell lithium or uranium. Our speakers have stood the test of time. Importantly, too, we have for 20 years featured what we call the living legends. Entrepreneurs like Ross Beatty, Robert Friedland, Sean Rosen, who have built multi-billion-dollar natural resource companies from scratch. Their experiences help you become a better investor, and they will tell you investing tricks that they have learned as a consequence of building these wonderful companies from scratch. Importantly, Patrick, unlike most investment conferences, we consider the exhibitors to be content too, not just advertisers. The consequence of that is that every public company exhibitor must be owned in accounts that are owned and managed by the conference sponsors. Unfortunately, there's no guarantee that because I own the stock, it goes up. But there is a guarantee that I have vetted the exhibitor well enough that I am willing to invest my time and treasure in them. And the consequence of that is that any attendee who comes to the conference, either live, by the way, July 23 through 27 in Boca Raton, Florida, or virtually, 1,000 people will attend from the comfort of their home. You will have the ability to access the conference recordings for 6 months after the end of the conference. This is important because you'll have to absorb 52 hours of programming in 4 days, and you can't get everything that we propose to teach you in 4 days. So having the ability to attend the conference in real time, but then learn and relearn the lessons over 6 months is invaluable. Invaluable enough that for this conference, like every other investment education product offered up by Rule Investment Media, we have a gold-plated money-back guarantee. If you attend the conference either in person or live stream and you think for some reason that you didn't get your money's worth, easy peasy, all refund your money, no questions asked. So I hope that gives you an overview of why we've been successful with this conference for 20-something years and why we look forward to this year's conference in Boca Raton, whether or not you attend in person or via live stream from the comfort of your home, will be the best conference that we have been able to provide in the last 20 years.
All right. So we'll definitely put a link for this upcoming conference. I believe it's July 23rd or somewhere around there.
July 23rd through 27th. Yes, sir.
All right. Okay. Thanks. Thanks a lot, Rick. I'm sure the viewers appreciate that as well. But I guess this is going to be one of the topics at your symposium. We keep hearing about shortages. Shortages are challenges to meet or keep up with demand with certain commodities such as oil, copper, nickel, and we're hearing now even silver. In your expert view, these shortage predictions, are they a cause of higher demand, maybe underinvestment with resource companies, maybe not enough exploration going on? But in your view, how or why are we hearing about upcoming shortages?
I think the shortages, and by the way, I believe in the next 5 years, these projections of shortages are real. I think the shortages are probably a consequence of three things. The first has been systematic underinvestment in exploration and development, going back 30 years, a very long period of systematic underinvestment, particularly in base metals and in energy. I think, too, that a second cause of the impending shortages are government action, increased social rents, increased taxation, increased regulation, economic nationalization. And I think the third is simply, and this is wonderful, it's not a bad thing, prosperity. There are 8 billion of us on Earth, and in the last 40 years, we've done a wonderful job of raising the material living standards of the poorest of the poor, exemplified, of course, by Deng Xiaoping in China saying, "To be rich is glorious," and lifting 450 million Chinese from rural penury to a middle-class urban existence. The continuation of the increase of the material living standards, particularly among the bottom half of humanity, is something that we should all celebrate. But increasingly, as the poorest of the poor and the merely poor have the financial resources to increase their material standard of living, they compete with you and I for access to those resources. Now, a word on shortages, Patrick. You can have supply shortfalls if you have a recession, which causes a demand shortfall, and prices won't rise. So we're seeing price stagnation in the equities around the base metals producers and the energy producers. You're seeing, too, backwardation of interest rates, at least in the U.S., which means that metals consumers and financial markets believe that we're going to have a recession, likely a recession, before we experience those shortages. So investors who are considering portfolio allocations in anticipation of shortages need to take into account the potential for a recession and the fact that a recession would make the price escalation that they're hoping to enjoy as a consequence of shortages delayed. I continue to believe that these shortages are absolutely inevitable. I think investments needed to have occurred 20 years ago and 30 years ago to eliminate the shortages that we're going to face in the future. But when I say in the future, I don't necessarily mean 2023 or 2024.
If you're enjoying this interview with Rick, Rule, and I, please consider subscribing to our YouTube channel. And if you're looking to invest in silver, I'd like to introduce Silver Bullion's new product, Star Silvergram, where you can buy silver by the gram at just 5% over spot with a 0.7% per annum storage fee. More details can be found on our website, www.silverbullion.com.sg. Yeah, it's interesting that you use that 5-year time frame because I was going to say, hey, let's move forward 5, maybe 10 years from now. Will we hear words like glut or oversupply with commodities such as oil, copper, nickel, silver, uranium, and cobalt?
I think we will see oversupply in some commodities that are particularly popular right now. I'm thinking lithium. Uh, the lithium price has increased fourfold in the last 7 years. And markets work. Increasing prices do two things. They constrain demand, while at the same time they increase supply. And the world is not short of raw lithium. It's short of processing capacity. We have experienced demand growth in lithium that has exceeded the industry's ability to respond in the near term. I do not think that we will see a glut, as an example, in crude oil, although we may see a glut in terms of liquefied natural gas on a global basis. And we won't see that glut simply because the oil industry on a global basis is underinvesting in sustaining capital to the tune of about $1 billion US per day. These sustaining capital investments are needed to maintain production 2 years out and 3 years out. And the new project investments, the large new projects investments in the oil and gas business, are really, really constrained. So my suspicion is, particularly around politically incorrect commodities, like fossil fuels, including, by the way, coal, that we will not see gluts, that we will see stronger than would otherwise occur pricing as a consequence of both industry underinvestment and the government discouragement of investment in these commodities. If we were to see $150 oil, $160 oil, we would certainly, I think, experience a glut. But I don't think you're going to see that. I think that you're going to see oil in a band, in a nominal U.S. dollar $60 to $100 band for a fairly long time. And the consequence of that is I don't think that you are going to see oil gluts. Although, as I say, you may see temporary gluts in liquefied natural gas, particularly if the Russia v. Ukraine situation calms down and there is a more material um, resumption of Russian gas shipments into Europe. I'm not saying that's going to occur, by the way. I said if.
Right. Okay. Yeah. So gluts with oil and natural gas, but uh, things like silver, because we're hearing this quite often now. I mean, are the days of, let's say, oversupply going to be numbered?
Silver fascinates me because it's very difficult to forecast. As an example, the last time I looked, only about 18% of silver supply came from silver mines. The rest comes as a byproduct of producing copper and gold and zinc. And so you need to know something about what copper prices are going to be like 5 years from now to forecast byproduct silver production. And I'm not smart enough to do that, to be honest with you. The higher the silver price goes, of course, the more economic recycling becomes. Right now, people aren't using solvent to extract silver from wasted solar applications simply because the silver price isn't high enough. But at $50 silver, you would see increasing flow from recycling. Uh, the supply side is also tricky because a whole bunch of silver is used for monetary purposes and savings purposes, and particularly in South Asia, the people that own these silver inventories aren't really anxious to disclose of them to their government. When the price rises, particularly if it rises in U.S. dollars, and the U.S. dollar does well against currencies like the Indian rupee, often dishoarding occurs. So supplies come out of nowhere. On the demand side, silver just gets better and better. Uh, Silver is really, really efficacious in some microelectronic applications, but it is dominant in reflective applications, which is to say solar panels. And solar utilization is growing worldwide. Increasingly, too, silver is important in water treatment and sewage treatment, germicidal and healthcare applications. And so what you're seeing now is a growing deficit in terms of new mine and recycling supply relative to current industrial demand. In addition to that, in some societies, you are seeing renewed interest in silver as a savings vehicle. You will note that the Indian government again is playing games with regards to taxes and excise taxes on both gold and silver. But it seems in India that government action has never been sufficient to constrain demand. It just enriches the smugglers. So I'm pretty attracted to silver. Now I think that that portion of your audience that is interested in silver as a speculative commodity needs to understand that price spikes usually occur around investment rather than industrial demand. And again, in my experience, I don't know why this is true. I just know that it is true, that a silver bull market needs to be led by a gold bull market. The gold buyer tends to be a fear buyer, and the fear buyer acts first. When the momentum is established in the market by the gold buyer, silver moves then further and faster. But it's a mid-market, mid-bull market mover as opposed to gold, which is the early market mover. And as we've discussed on your show before, Patrick, the most volatile asset of all are the silver equities, simply because the market capitalization of the real silver equities is so small that when the silver narrative becomes attractive to the generalist investor, there literally is not enough market capitalization to hold the money. And you get these absurd price spikes. I remember back to the 1970s when I was a very young man. Coeur d'Alene is an example, going from 10 cents to $65. Sadly, I wasn't able or willing to participate that time. But the next silver bull market that I experienced in the early part of the decade of the 90s saw both Silver Standard and Pan American go from 72 and 50 cents, respectively, to over $40. What speculators need to understand is that these unbelievably rewarding markets occur sporadically and infrequently. But when they occur, they are really particularly dramatic.
Okay. Rick, yeah, quite a few touch points there, but I want to talk about we often hear governments how they can throttle the resource industry, stories of how governments, they can tie up permits, bureaucracy, or how production, even product turns political. And we're kind of seeing this happening now today. But can you reflect back on a time where other than oil or war, where resource commodities were politicized for either internal economic gain or used to inflict external economic pain? And what were those commodities?
The only commodity that I can remember that became politicized in that regard was oil during the period of the 70s with the Arab oil embargo, where the Arab community felt both that the West was unfairly backing Israel relative to Muslim residents of the former Palestine. But I remember what I would consider to be a related phenomenon, where, as a consequence of the run-up of commodity prices in the 1970s, governments around the world both increased social rents on extractive industries, but also very often nationalized things. It's interesting, both the timing and the result of that. Of course, governments aren't smart enough to steal stuff when it's cheap. They require confirmation from commodities prices. So the governments, as an example, in Zambia and Congo and Mexico and Peru, nationalized assets at the beginning of the decade of the 80s, after the price run up of the 70s, just in time, of course, for the price collapse. In addition to that, mining and oil and gas are fairly complex businesses. They should not be run by the post office. So when countries like Venezuela and Mexico and Peru and Zambia and Congo nationalized their industries, in addition to the fact that they nationalized them at the top of the market, they ran them very inefficiently. And as a consequence, as an example, Venezuela, with the largest crude oil reserves in the world, has seen a precipitous decline in oil production. It has taken special skill, too, for Mexico, as exhibited by Pemex, to destroy the economic benefit to the country from absolutely unbelievable reserves and resources. Congo, the home of the richest copper fields in the world, drove their copper mines into bankruptcy at Jekamen through corruption and, frankly, stupidity, as did the Zambians at ZCCM. So the phenomenon that you talk about, the politicization of resources, is a continuing concern, not just for the industry, but also for the citizenry, both as consumers and ultimately as taxpayers. You don't enrich a country by bankrupting its most competitive industry.
I saw something you had said on recently on David Lynn's channel. So shout out to David Lynn. But you said something where we have invested 5 trillion US dollars in alternative energy over the last 40 years or so, and with this effort, we have reduced the market share of fossil fuels from 82% to 81%. Now, I'm not sure whether to laugh or cry when I hear this, but what does this say about the ability to move away from fossil fuels anytime soon?
Well, I think the answer to that is self-evident. That number, by the way, comes from Goldman Sachs. It wasn't dreamt up by some cranky old bald libertarian named Rick Rule. It says several things. And by the way, I'm not anti-alternative energy. I've invested in low-head hydro, I've invested in geothermal, solar, wind, all of them. In fact, I'll invest in any kind of power that you pay me to produce. I'm fine with that. It only goes to the narrative around energy transition. The big thinkers in the world, the Trudeaus and the Bidens, the Merkels and the morons like that, would have you believe that there's going to be in the near term some form of energy transition. And I just wanted to point out the arithmetic. As a consequence, partly of an expanding market, particularly the material advancement of the poorest of the poor, despite the fact that we've invested almost $5 trillion in energy transition, we have in fact reduced the market share of fossil fuels, including coal, as you quoted, from 82 all the way down to 81%. Let's examine the facts in addition to that. The big thinkers don't seem to realize, Patrick, that there's 1 billion people on Earth with no access to electricity. There's another 2 billion people on Earth with access to only intermittent or unaffordable electricity. And those folks want to live like you and I do. And you and I live an energy-dense life. So demand for all forms of energy is going to increase, and is going to increase markedly in the next 20 years. Will we need more solar? Absolutely. How about wind? Yep. Oil and gas? That too. And coal? Absolutely. In terms of the carbon question, and I do not believe that we should be pumping more junk into the atmosphere or into the water. I mean, I get that argument. But in terms of carbon abatement, the big thinkers in the world need to understand that voters and consumers in frontier and emerging markets countries, poor companies, think the Western idea, where carbon emission is measured on a national basis, is stupid. They think it should be based on a per capita basis. In other words, societies that are rich, where the consumers consume more power, should bear more responsibility. And by that standard, places like China and India won't face as much monetary penalty for carbon as places like the United States and Germany. And these same countries suggest that the total population of carbon, emitted carbon in the atmosphere, is mostly the result of legacy economic activity, which is to say that that carbon has been generated by the North and by the West, and as a consequence, the poorer nations in the South deserve a credit. Now, this is all well and good. I think it's absolutely impossible to get Western voters to reduce their material standards of living in favor of something that they consider to be nebulous, which is to say carbon emissions. So I think the probability of meeting the 2050 carbon goals are nil without very broad spread adoption of efficient baseline non-carbon generating power like nuclear, and without massive substitution of natural gas and liquefied natural gas for coal. We ain't going to get there with windmills and solar panels. Not going to happen. Now, people might have an ideological problem with that, and I don't have any problem with their ideological problem. You just need to look at the arithmetic.
Completely agree there. Thanks for touching on the carbon topic. But Rick, going forward, the world is making this effort to go green, but I want to go backwards a little bit and talk about the greenback and the effort to de-dollarize from the US dollar. Is this a concern for you, or at least what kinds of changes could we perhaps expect to witness?
I think a multipolar world ultimately becomes a healthier world. I don't believe in the hegemony of any group of people over any others, despite the fact that I, as an American, have been a huge beneficiary of that during my lifetime. I am not one of those Americans who suggests that efforts to de-dollarize around the world are the result of some demon foreign influence. I think the greatest enemy of the U.S. dollar is the U.S. Congress and the U.S. presidency, and they've hurt the dollar franchise in at least two ways. The first is by making dollar-denominated debt securities, U.S. government securities, less attractive. The interest rate on U.S. government securities relative to the depreciation of the purchasing power of the dollar makes long-term U.S. government debt arithmetically a bad buy. The U.S. government debt market is the deepest, most transparent, most liquid market in the world, hence the strength in the U.S. dollar. But the U.S. has gone further to debase its franchise. They've weaponized the dollar. They have attempted to use the dollar and the SWIFT banking system to extraterritorially impose U.S. values of various kinds on countries that have much less interest in U.S. values than the U.S. does. So countries that see themselves experiencing moral suasion or worse sanctions, countries like China, countries like Russia, countries like Saudi Arabia, countries like South Africa, like Iran, are being in some senses forced off the U.S. dollar for their own security. Now, I am not one of those who thinks that the U.S. dollar is going to surrender its position as the world's reserve currency in my lifetime. The U.S. has too many advantages. The currency is convertible, unlike most of the other currencies that oppose it. The U.S. Currency market and U.S. debt markets are extremely transparent by global standards and extremely liquid. And I think one sad truth in the world is that while many countries don't trust the United States, nor should they, ironically, they trust the U.S. more than they trust each other. There has been a discussion of this new currency, quote, the BRICS. First of all, there's this idiotic notion that that currency will be backed in gold. What might they use for gold? They don't have enough gold to back a currency that could be used ubiquitously, even among those countries' own citizenry. They don't have enough gold to back a currency. Can you imagine if you had 100,000 bricks in your wallet and you decided that you wanted your gold? First of all, with 20 countries backing the currency, who would you get your gold from? Let's say you chose Russia, which has a large amount of gold relative to GDP, and you said to Mr. Putin, here's my 100,000 bricks. May I have my gold? What do you think the answer would be? And what do you think your recourse would be in Russian courts where the Russians have the guns? Um, this is truly silly. Doug Casey famously said that the U.S. dollar was an IOU nothing. He said that the euro, backed by 17, I think it is, European countries, was a who owes you nothing. Well, if that's true, the BRICS, backed by such stalwarts as Argentina and South Africa and Brazil, must be a nobody owes you nothing. Uh, so I guess I think that the U.S. dollar continues to be the worst currency in the world, with the sole exception of every other one. I would urge people to denominate their savings in several assets. U.S. dollars, to be sure, if you live in the United States, because you have to, but also in precious metals, uh, which I consider to be good, if volatile, money.
Okay, just want to play devil's advocate a bit here. Uh, the theory goes that yes, there is not enough gold out there, and so what they look at doing is perhaps raising the price of gold to somehow balance the amount of currency that would be out there. Would that be a possible solution, or still fantasy?
I think it's pardon the phrase, I think it's a wet dream for gold bugs. I don't think that a backed currency, backed by anything, is in the interest of any politician. An honest currency, a currency that's backed by something, is a currency that constrains the power of politicians to borrow and print. And I don't think that there's a politician on the planet, not Putin, not Biden, not some unpronounceable to me African politician, who is interested in having his or her power constrained. And I think that is the predominant thing when people need to consider the probability of some currency that's backed by anything other than lies.
I've heard you regard precious metals as an insurance. Can you identify the time where, let's say, you once saw gold as an investment and then some event or whatever may have happened where you then started to see gold as an insurance?
Well, I certainly saw gold as a speculative asset when I was very young. I understood the impact of price controls on gold in the late 60s as a teenager, largely because I read books from people who showed it to me. This wasn't original research. And I understood that there had been inflationary pressures in my home country, the United States, in the 1960s, from the sort of simultaneous expansion of both guns and butter by the government and the fact that gold was price controlled. It was pretty clear to me that when the price control came off, that it would be sort of like, taking the cap off a carbonated beverage. So I got that part. As I began to trade gold, as I began to own gold, invest in gold, all those kinds of things over the ensuing 15 years, I became much more interested in studying the history of gold and in studying the interplay between human volition, which is to say will, and gold. And what I think I've discovered is that gold has had a function of being both a medium of exchange and a store of value. Gold isn't a promise to pay, it's payment in and of itself. And so gold doesn't require trust. Fiat currencies and debt instruments denominated in fiat currencies really are a function of trust. And at those periods of time in certain societies where social trust is eroded, or where the depreciation in the purchasing power of the currency has declined faster than interest income on savings, gold does very well. And for that reason, that realization, that study of history, I've decided that for me, as an investor, I tend to invest in productive asset classes, which is to say, in businesses that can increase their earnings, increase their free cash flow, or in developed real estate where my cost of capital stays fixed but my return on capital increases. That's how I invest. I regard gold as insurance against the depreciation of my purchasing power in various fiat currencies, including the currency of my own country, the US dollar. And I am nervous as a saver in US dollars, although I have very large amounts of US dollar liquidity. I'm concerned about the arithmetic around long term US dollar denominated debt. If you look at we've talked about this before, if you look at the arithmetic around the world's predominant savings instrument, which is the US 10-year Treasury, sorry to be US centric, but that's just the way it works. This is the deepest and most liquid securities market in the world. It's the ones that others are benchmarked against. If you look at the US 10-year Treasury, I think right now it's yielding 3.3, 3.35 in a currency that the Congressional Budget Office suggests, including food and fuel, is depreciating by 6% a year compounded. Now, that's kind of tough math. What that means is that they're guaranteeing me almost a 3% decline in my purchasing power annually for 10 years. Patrick, I think it's worse than that because the inflation statistic that they quote in determining the deterioration of my purchasing power doesn't include tax. And the biggest household expense for every working household in the United States is tax. It's greater than shelter, food, energy, and transport combined. A cost of living calculation that doesn't include tax is fallacious. And so for those reasons, I feel like I need the insurance in terms of purchasing power over time that's provided by gold.
With all the central banks buying gold, and then again with the outlook of silver, where we do see it, going into a situation where demand is going to be outstripping supply. Why aren't we necessarily seeing the price needle move with both metals?
I think, and I'm making this up, Patrick, okay, this is not fundamentals, this is just my observation. I think that investors and savers worldwide have been lulled into a sense of security by living through the period 1982 to 2022, a period of increasing world peace, a period of increasing world trade, a period of demographic boom, and a period in particular of lower interest rates and very, very, very low cost of debt and equity capital. I think the circumstance changed in 2022, but I think investor perceptions were formed in a very benign period. Fear is what drives precious metals. And there has been an absence of fear as a consequence of living through absolutely benign times. I'm not trying to say that there weren't some challenges, 2008, things like that. But society recovered from those challenges. And I think people came to believe that the big thinkers had a lot to do with those recoveries. I don't think the big thinkers had anything to do with those recoveries. I think it had to do with demographics and technology, but that doesn't matter. I think that perceptions were formed in very good times. I remember back to 1969, 1970, when I was a very young man, but interested in investments. We'd been through a time, post-World War II, the late 40s, the 50s, the 60s, which were similarly benign times. The U.S. economy in particular was growing like gangbusters. People were getting richer. People were entering the workforce. Family formation was happening. And nobody was afraid of anything. At the beginning of the decade of the 1970s, most people couldn't spell gold. It was a four-letter word. When that American dream unwound a little bit in the period of the 1970s, when we had to pay back the debts associated with guns and butter, by the end of the decade of the 70s, but it took 10 years, everybody could spell gold. And my suspicion is that it will take us 5 or 6 years to unlearn the lessons that we learned over 40 years in the period 1982 to 2022. In prior discussions, Patrick, you may or may not remember this, but I quoted some interesting statistics from J.P. Morgan Chase, which said that the current market share of precious metals and precious metals related securities in the United States was 0.5%, which is to say 0.5% of all investment and savings assets in the United States are denominated in precious metals. The 4-decade mean was 2%. My thesis is pretty simple. The deterioration in the purchasing power of the dollar, particularly relative to US dollar denominated debt instruments, is now pernicious enough that I think the market share of precious metals will climb from 0.5% to its 4-decade mean, which is 2%. If that occurs, I think demand for precious metals and precious metals related securities will quadruple. And that's what I think is going to occur. I'm not one of these who says that, the US dollar is going to crash and burn, go to hell in a handbasket, and gold's going to replace the US dollar. I think that's silly. I think gold will lose the war less badly. And I think as a consequence of that, investors, savers, or insurance owners like myself would be well advised to diversify into gold and maintain gold holdings. Speculators who have the same view of history that I do, have made the same observations that I have, might consider, as I have, silver as a speculative class, because in the middle and later parts of a gold bull market, silver outperforms gold handily.
But I mean, what comes to mind for yourself when you come across articles from, say, Bloomberg, where they say gold is no longer a hedge against bad times?
Well, I'm personally very grateful for those articles. I'm acquiring gold myself on a systematic basis, and I would rather acquire it cheaply than dearly. I note, too, that while I'm a Bloomberg user, mass media needs to repeat mantras that are commonly held, whether or not they're true. Bloomberg needs to be credible so that the advertisers on Bloomberg, the BlackRocks of the world, the Fidelities of the world, the Vanguards of the world, can sell their pablum to consumers who are conditioned to believe that the circumstance of the past is the same as the circumstance of the future. We used to call this the Business Week effect. Business Week had such ubiquitous circulation among the business community in the United States that they really couldn't say anything controversial because it was not in the interest of their advertisers. So, as an example, in 1982, at the very beginning of the most explosive bull market in equities we've ever seen, Business Week had a headline called "The Death of Equities." Some years after that, in a spectacularly bad call with the oil price at $10 or $11, Business Week magazine had a headline about the end of oil. What you find is that market bottoms and market tops are often called spectacularly well by popular media. It's just that while their timing is right, their call is specifically and precisely wrong. And I think that the Bloomberg comment about the cessation of interest in gold has a lot to do with who they are, what views they represent, and the reputational advantages of reinforcing the status quo that exists in their subscribers' mind. That's one of the reasons why at our conference we present a very, very different point of view.
All right, look forward to that. So I guess gold and silver has a pretty good outlook ahead. But Rick, before we head out here, can you let us know more about that Rule Symposium conference and how people can follow you on social media?
Yeah, let's do them in reverse order. We've talked about the conference, which I will return to. The best way to follow me on social media is to go to ruleinvestmentmedia.com, all one word. There, if you would like to hear more about my views, I can make them specific to you. If you list your natural resource stocks at Rule Investment Media, I personally will rank them, if I know them, 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues where I think that my comments might have value. By the way, if you invest in precious metals and would like to borrow against your precious metals as security, in the question and comment section at Rule Investment Media, write bank. I'm starting a new bank in retirement, and one of our investment products will be that we will lend against individuals' precious metals holdings in segregated storage. As to the conference, Rule Investment Symposium, go to rulesymposium.com or click on the link that will be below this interview. You can attend in person. You can attend virtually. If you invest in natural resources and precious metals, I highly encourage you to attend. And I'm going to make it financially riskless. If you attend and for any reason you don't believe you got your money's worth, gold-plated guarantee. I'll give you your money back.
All right. Look forward to those. We'll definitely put the links down there for people to go ahead and click on. But Rick, I'd like to thank you once again for your time and wish you all the best in your upcoming symposium and hope we can do this again soon.
Patrick, I always look forward to these interviews. I always enjoy them. You're well prepared. You ask great questions, and so I enjoy the whole process. Thank you so much for having me back on.
All right. Thank you also, Rick. Appreciate it. That was Rick Rule sharing his views on the economy and gold and silver. To follow more of Rick's views, head on over to ruleinvestmentmedia.com. If you like this video, please hit the subscribe button, share, and give us a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.